Hi. So in this particular video, we are continuing our discussion of balance of payments that we started in the balance of payments video part 1. So if you're now joining us, if you want to catch up, you could watch the previous video just to get a clear understanding of what we're doing and where we're going. So as we stated before, the balance of payments is actually a record of all transactions of a country and the rest of the world, all of its other trading partners, and therefore balance of payments has different components. Okay, there's the current account and there is the capital and financial account. All right, but I broke it down into three here: the current account, the capital account, and the financial account. And these are the three main components of your balance of payments account. And what you're going to see is that even the current account is further subdivided into sub accounts. All right, now let's go on to the current account. What the current account actually does is that it captures the net value, all right, of all goods, services, income, and current transfers that take place between a country and its trading partners. Therefore, because it looks at so many different issues, the current account is subdivided into a balance of trade that records the net value of the physical goods. All right, the balance of trade records the net value of the physical goods that we discussed here. The balance of services component records the net value of all services. The income aspect records the net value of income. And then there's the government transfers that records the net value of the transfers. Example, foreign aid. So therefore, seeing as the current account captures all of these things, the goods, services, income, and current transfers, there are four subcomponents or four components of the current account, which is also a component of the overall balance of payments. So for instance, if you're a country in the Caribbean, there's a lot of agricultural produce. So if you produce bananas or sugar or other agricultural products and you export it, it means that will be captured. The revenue gained from the export of these physical goods will be captured and held in your balance of trade component account. All right, and that'll be inflow because remember, you are selling goods, you are exporting, and therefore you're receiving money in return. Also, when some countries, they engage in tourism services, and therefore when individuals come into your country and therefore they pay you for your tourism services, what you're actually doing, while it's not a physical good, you are actually creating value for someone that they're paying for it, and therefore it's called a service. And therefore when tourists come into your country, the money that is gained from the services provided by your country for tourism, that will be recorded in the balance of services account, and that is going to be the money we get. That's income coming in. Now, of course, when we travel from the Caribbean and going to other countries in the US or the UK, that is now outflows because we are spending money that we would have earned locally in our jobs and spending it abroad. So therefore, we are actually importing services from abroad. So any type of service, the income or the expenditure is going to be captured in the balance of services component of your current account. And therefore we have income. This records the net value of incomes that is generated, that is either coming into your country or going out of the country. So for instance, let's say you have income generating assets like shares or stock in a particular company abroad. When they are paying you a dividend payments or other income payments, that is going to come in through your current account in the income aspect, and therefore that's money coming in. Likewise, if there are foreign investors in your local economy investing in your local business in your own home country, when they are being paid their interest payments or their dividend payments, that is going to be an outflow because that's money leaving your domestic firm and paying a foreign national. And then lastly, your government transfers. This records the net value, and therefore an example of government transfers is when a government gives foreign aid. That's going to be recorded in this component. So we see here your current account has a lot of work to do. It records the value, again, the outflow of money and the inflow of money with respect to goods, services, income, and current transfers. Now let's look at the capital account. The capital account records the value of the inbound and the outbound transactions that pertain to capital transfers like financial aid to foreign countries, debt obligations, or relief through organizations like the International Monetary Fund. So just to put it in a clearer picture now, this deals specifically not the trading of goods or services, but when money is given for a particular issue. Let's say a country is experiencing a recession and they have difficulties in borrowing from other agencies. The International Monetary Fund may step in and it may give them assistance in the form of money, which is to get the economy running again. So that's a capital investment that will be recorded by the country in your capital account. So that's money coming in, but of course, when you have to service that debt, that's money going out. But it's not going to be recorded in the capital account, but that's going to be recorded under income. All right. So the balance of payments is each account is intricately tied together. So the capital account only records that initial assistance given by the IMF, but other interest payments or income being paid, that is going to come out through your current account under the income aspect. So we have the capital account. Let's look at the financial account. All right. The financial account of your balance of payments records the value of the inbound and the outbound transactions that pertain to the purchasing or the sale of assets internationally. So, for instance, now here we have now the purchasing of financial assets. So you invested in a company abroad. This is going to be recorded in your financial account. All right. So that investment is recorded here when you purchase shares or you purchase a business. Money coming in from, let's say, the income from the business you may have purchased or the sale of your shares, that is, however, not going to come into your financial account, but it's going to come in your current account under the income aspect. So again, we see here the initial transaction of purchasing a firm or purchasing shares in a business will be recorded in your financial account. Now, when you purchase assets abroad, you're investing in a country abroad. So what you're going to see is that will actually be recorded as money leaving your country. So even though purchasing a business abroad or shares in a business is something good for you, that's money leaving your economy, and in your balance of payments is going to be representative as an outflow. However, when you begin generating income from these assets, that is going to be an inflow. That's money coming into your country, into you, and therefore you're going to see yourself spending that income in your local economy somewhat. So therefore, again, we could see that the balance of payments is a very intricately tied account between itself and its sub-accounts. We have the current account, we have the capital account, and we have the financial account. And we also have, with the current account, the different sub-accounts included there. Your balance of trade, your balance of services, the income, and your current transfers. So we can pull all of that together. And what we have here is how the format of how your balance of payments for a country could look like. So you have your current account, we have your capital account, we have the financial account, and of course, human error, some things can take place. We have a balancing item, right? That takes place here. And what we realize here is that your balance of payments will always net to zero. Your balance of payments must always balance. Sorry for the pun there, but your balance of payments will always balance, and I'll explain that in a while. So we see the subcomponents: current account, your capital account, your financial account, and of course this balancing item to ensure that it nets to zero. And your current account has your balance of trade, so physical goods that are imported or exported, the net value is recorded here. Similarly for services, that the import or export will be recorded here. Net income in the government transfers. So we tally this entire value and then we pull it across here in this column, and so therefore everything here adds up to the balance on the current account. Then we have the capital account, the net capital transfers, the value is here. The net gain on financial assets recorded here, and here we have our if any computational errors may have taken place, and the balance it nets out. Now, why does it always net out? Well, let's see on this side here. What we're saying here is that the current account, represented by CA. So CA represents your current account, KA represents your capital account, and FA represents your financial account. So that's the explanation of the variables. And what we're saying here is that the current account plus your capital account plus your financial account will sum to 0. We're seeing that here. Therefore, we're saying that if the current account is in deficit, then now it means if you transfer it across here, you realize that if the current account is deficit, you simply carry current account from here on this side of the equation on the other side of the equal sign, and therefore capital account and your financial account, they still remain positive, but if you carry across the current account, the plus turns to a minus on the other side of the equal sign, and therefore we have a deficit in your current account will mean that you have a surplus in your capital and financial account. And if you have a surplus in your current account, it means you have a deficit in both your capital and financial account. Now, how does that happen? Well, the reality is this. If you have a deficit in your current account, it means that more money flowed out of your country than it came in. So you spent more money on foreign commodities than local economies. And therefore means that you would have had to give up your local currency to purchase the foreign exchange to import the foreign goods. It means there is an increase in supply of your country's local currency in the open market. It therefore means whoever has access to your local currency now would increase their holding on your country's domestic assets, right? There's a possibility of increasing their holdings on your country's domestic assets, which ultimately will be an inflow in your capital and your financial account. So therefore, a deficit in your current account, which means that you would have spent more on foreign assets, that is an outflow. And those who receive your domestic currency will now be able to increase their holdings on your country's domestic assets, which will be seen as an inflow in your capital and financial account. Therefore, the deficit in the current account, which results in an outflow, will bring about later on an inflow in your capital and financial accounts, hence the balance. Likewise, when you have a surplus on your current account, it means that your country exported more than it imported. It means therefore that you would have received more money coming in than you lost. And it therefore means that with the increase in the foreign exchange that your country has received, it means the domestic residents can possibly now increase their holdings on foreign assets. And when domestic residents increase their holdings on foreign assets, it will result in a negative or an outflow coming out of your capital and financial account. So therefore, we see that the surplus in your current account is compensated by a deficit in your capital and your financial account. Hence, your balance of payments will always balance. So therefore, what it means is that we have to go beyond and understand the interpretations when we talk about current account deficits and current account surpluses and the implication that they can have within an economy. And we shall go into these implications in a subsequent video. So please stay tuned. Thank you.